Hi, everyone. Thanks so much for joining us. We are just getting started right here, so we're going to give it a minute or so to let people trickle in, and then we'll get started with the presentation. So just sit tight for maybe another minute or so, and as the numbers keep popping in. So we're seeing people joining, and we'll get it started here momentarily. All right, thanks so much. We're seeing a couple more attendees trickle in, so we'll just give it a few more seconds here and see if anyone else joins, and then we'll go ahead and get started. Okay, thanks everyone for joining us for April's STDL CLE. We are pleased to have with us Dan Huckabee, sorry. He is the president of Court Surety Bond Agency, one of the leading providers of appeal bonds in the United States. Dan is an expert on appeal bonds, having underwritten appeal bonds in almost every state for every type of client you could possibly imagine, from athletes to professional sports teams to Fortune 500 companies. And he's a frequent speaker on all issues relating to appeal bonds and is a expert in the field, we are happy to have him here with us. And he's going to give a overview of everything a lawyer needs to know about appeal bonds. So with that, I will turn it over to Dan.
Thank you very much. Appreciate being here. It's always nice to have an opportunity to give these presentations, and hope to educate everyone on the world of appeal bonds, which is something that we find is often mysterious because lawyers don't have to deal with it all that often. Even experienced appellate practitioners deal with it only infrequently, and so it a lot of times can be a whole new learning process and things that people have to kind of rediscover. So the goal, hopefully today, is to kind of give you a fundamental knowledge of how appeal bonds work. Being defense attorneys, hopefully you never lose a case, but in the event you do, you have a client that wants to appeal the judgment, then having at least some basic knowledge of the way the process works can hopefully help you better serve your client. So this is kind of a outline of what we'll talk about, just a basic introduction first, then we'll get into the underwriting requirements, talk about costs a little bit, and then we'll talk about the time frames for getting the bond, but then at the conclusion of an appeal, actually releasing the bond. I think as we go through it, I do have the chat or the question and answer open, so I'll try to keep an eye on it. If you would like to submit any questions, please feel free. One thing I was mentioning before starting the presentation is there's often people have unique experiences that they want to get addressed. And so if I touch on something that you've gotten some conflicting information for, or something along those lines, you had a particular situation, feel free to put it in the chat and I'll try to answer it as we go. Otherwise, there'll definitely be time at the end to answer any questions you might have. I always like to start out with kind of a broad overview of surety bonds, just because it's not something that people are generally all that familiar with. Surety bonds, if you're not aware, are provided by insurance companies through brokers. It's about 1% of the overall insurance industry, so it's about a $6 billion industry, which is a very tiny fraction of insurance. And appeal bonds are an even smaller subset of the surety industry. It represents about 2% of the surety industry. So as you can kind of tell, it's a very niche area of the market. And most people that provide insurance agents may kind of dabble in surety bonds. You do get some specialists that provide surety bonds, but they may even be, generalists when it comes to providing surety bonds. And then you have more specialists in different particular areas of surety bonds, and our company has a focus on appeal bonds. So I always like to say that, just because if you've come across somebody you've talked to that has said something that may be different, it may be simply because they don't particularly specialize in the product. To give you an example, most insurance agents probably provide 1 or 2 appeal bonds maybe in their whole career. We tend to do it day in and day out, doing hundreds of these cases every year. So we'll start out with touching on just the rules, both in California and federal court. 917.1 requires that an undertaking in the amount of 1.5 times the judgment is put in place. So California uses the terminology of an undertaking for surety bond. I will use the terminology of appeal bond, but just know that I'm referring to the same thing. And California is somewhat unique in the requirement. It's a fairly high requirement relative to other states. There are some states with higher requirements. New Mexico is one. They actually require 2 times. And so a lot of times it's based on the rate of statutory interest and how long the average appeal goes on. But so California, that can be a significant factor. If someone has $1 million judgment, they can be required to post $1.5 million appeal bond. Another thing in California is generally are immediately enforceable. There's a lot of nuances to that you all are more well-versed than I am in terms of post-trial motions and things of that nature that can delay that immediacy of the enforcement of a judgment. But it's important to know there's no automatic stay that California has, which plays an important role in the timing of when to pursue exploring an appeal bond for the client. In the federal court, there is an automatic stay. It has actually changed in 2018 from 14 days to 30 days, which is a significant help in terms of allowing some time to get an appeal bond in place. There's no one rule for all federal courts. Each district court actually has its own rule in terms of the bond amount that's required. In general, it's the judgment plus federal rate of interest and cost. We often find that equates to somewhere around 120% of the bond amount, just as a general rule of thumb, but you would need to look into the local district court in order to determine exactly what the rule is and potentially make a motion of the court to approve the bond amount. So now we'll get into the typical underwriting requirements of surety insurers. These bonds often require collateral, and the reason for that is the premium rates, which we'll talk about a little bit later more specifically. But in general, what these bonds are guaranteeing is they are guaranteeing to the other party that if the appeal is lost and the judgment is not satisfied by the appellant, that the surety company will pay. So it's a straight financial obligation with a pretty simple trigger on it, and there's not much of an investigation or defense that the surety company can do. So essentially what they're doing when they underwrite these bonds is determining whether the appellant has the ability to satisfy the judgment easily on their own. And that's kind of a high bar to clear, just because the surety company has to consider that the appeal may last several years, and it's also possibly a transactional relationship, so they don't have an ongoing relationship with the client. So they're having to kind of meet someone for the first time and make an assessment as to whether this company or individual will have the means, several years from now in order to easily satisfy the judgment. And so there are cases that we will talk about that where sureties will approve bonds without collateral, but the majority of them do require collateral. And part of that, as I was about to touch on, is the premium rates are so low for these bonds that the average rate is probably around 1%. They do vary based on the collateral type, but if you think about getting $1 for every $100 of exposure that you put out there, making one bad decision can wipe out a lot of really good decisions. And put that in perspective, we have a surety here locally in California that during the 2008 financial crisis had made some poor underwriting decisions combined with the change in the market, and it took them 10 years to make up the money they lost in 2008. We had another company actually based in San Diego that in the same time period had lost all the profit in 2008 that they had made for the past 30 years. So the risks are fairly significant for these surety companies, and those weren't all related to appeal bonds, but the premise is the same, that the premium rates are relatively low compared to the exposure. So the only way to protect themselves is to, in those cases that don't clear the bar, is to require that collateral. The other items we generally get are pretty basic: just a copy of the court complaint, the judgment or the order, and a copy of the notice of appeal when it's been filed. So these are the forms of collateral that are accepted: cash, letters of credit from banks, real estate, and stock portfolios. And we'll talk about each one of these in more depth individually. One thing I always like to note, though, as we do go through it, is to keep in mind that these can be used in combination with one another. So if a client has a piece of property that maybe isn't quite sufficient to cover the entire bond amount, then cash can be supplemented, and that's a common form that we see used. So some of the things with cash is the cash is essentially wire transferred from the client's account to the surety company. The surety company holds it in a trust account, and some sureties do pay interest on the deposit. Right now, the interest rate environment being what it is, the interest rates are relatively low. They're paying about 0.5%, but any of you who have looked at your own bank account recently probably know that 0.5% is actually probably more than any of us are getting. So it's actually a decent amount of interest compared to what most people get in today. And at one point, it was actually up to 2%. So the amount of interest, it's possible for the amount of interest to even cover the bond premium that the client pays for the appeal bond. The cash is simply wire transferred to the surety company. So it's pretty straightforward. And some sureties, in certain instances, will require less than 100% cash if it's kind of a borderline case where the client almost qualifies with no collateral, but most of the time 100% collateral is required. Letters of credit, in case anyone's not familiar with what they are simply a letter from a bank that states that they will make available a certain amount of money to the surety company to be drawn upon in the event that the surety company makes a demand because of a claim. And they're pretty broadly worded. There's no real requirements stipulated as to what the draws, what triggers the draw. So that from the surety company standpoint, it's very comparable to cash because they have immediate access to it. The main difference is the surety companies do underwrite the bank to make sure that it's an acceptable bank. There have been times, again, like in the 2008 financial crisis, where banks were struggling and didn't honor the letters of credit that they had put in place. And so surety companies were left empty-handed. And so it is important for the surety companies to evaluate the banks they're getting these promises from. But you know, most of your household names, Wells Fargo and Bank of America, and you know, large institutions of that magnitude are acceptable. It is based on the size of the letter of credit too. So you might have a smaller financial institution and a very large letter of credit that the surety company may not be comfortable because it's just too large for that particular financial institution. We rarely see banks not approved. When they aren't approved, it's generally a very small, you know, maybe one branch local community bank or something of that nature. But we always like to get approval first just to, you know, avoid that issue. And then last thing to note is the surety companies do have their own specific letter of credit format that we provide to the client that they can then provide to their bank. And we don't generally see issues with coming to terms on the wording, although sometimes there will be things that, you know, have to be addressed and back and forth. Real estate is probably one of the most important options, especially in California, given our market climate with real estate prices here and just the amount of equity that people or companies tend to have in real estate. So I always like to spend a little bit of time on this form of collateral because it can be so important. So we always like to note that it's not accepted by many sureties. There's really only 2 sureties in the marketplace that accept real estate. So if you've ever been told that real estate's not an option, it could be because either that agent doesn't represent these companies or just wasn't even aware, because it's not all that common among all the sureties to be able to accept real estate. There's one of those 2 sureties that does it much more often. So we kind of often find that there's really, you know, one solution, but it's a very good solution. The real estate in general can't be a part of the court case. There are some exceptions to that, but typically it can't be a part of the court case. And it's got to have enough equity in the property to cover the bond amount. And we'll talk about that a little bit, how the surety looks at the equity. And then lastly, the bond amount has to be greater than $300,000 because of the time and cost it takes to put the real estate in place to secure the bond. So as far as the types of property that can be used, you know, location, just like we all know, is a very important factor in real estate. You know, remote areas that don't have a lot of other properties around are more difficult to value, and so it's more difficult for a surety company then to accept them as collateral. As far as, you know, specific types of property, we've taken a wide range of properties to use with the surety as collateral: single-family homes, apartment buildings, office buildings, retail centers. We've taken raw land, a Panera Bread, commercial building, so quite a variety. So it really, there's not a huge limitation. There are some exceptions, and I know there the use of the property can be one of the limitations. We had someone come to us that was a hospital that wanted to put that one of their buildings up, and the issue that surety had with that is the code requirements for maintaining that hospital was just something they weren't familiar with, and and they were concerned that they wouldn't know how to operate the building in the event that they ended up having to foreclose on the property. So another one we got was a vineyard in California, which again, there's probably few buyers for a vineyard, and so finding the true market value and actually finding a buyer in the event that the surety had to foreclose is challenging. So I mentioned earlier that we have used raw land. It is rare to use raw land just because it has to be in such a good area, but the example that we were successful at in the past was a parcel in Park City, Utah, which densely populated, very popular, obviously. And in California, that certainly could be the case because there are so many great areas that, there can be small pockets of land located in. So those are definitely things we can explore. As far as the amount of debt, surety companies prefer properties that have no debt simply because it puts them in first position. So kind of no surprise there, but they will consider properties that have debt. They simply want to make sure that the debt is a reasonable amount. And what constitutes reasonable to them is generally considering how likely is it that the property, that they will have to foreclose on that property and pay off the first. If you think about it from the surety's perspective, if they're in a claim situation where they had to write a check for the appeal bond, and now in order to recoup their money, they may have to pay off a first mortgage. That's a lot of money to spend and put out prior to recouping the potential loss on a property. So their preference is to not put themselves in a situation where they're going to have to pay off that first mortgage. They would like there to be enough equity that the client has the flexibility of maybe refinancing the property and pulling out enough money to pay back the surety. That way, they're not sitting there and spending all those funds in order to do that. So typically, the typical process is the surety, when someone comes to us, we have somebody that came to us just this week that wants to use properties. We generally do an initial evaluation of those properties, see what the surety company might accept. Then once we narrow it down to whatever property or multiple properties is going to be considered, the surety company will evaluate that, give kind of a preliminary approval, and then they'll require an appraisal to be done. Appraisals can be waived if there's been a recent appraisal or if the equity in the property is so significant relative to the bond amount that the surety company isn't as concerned about the appraised value. But most of the time, appraisals are required, which the client does pay for, and it does become a factor in the timing because appraisals can take anywhere from a week to several weeks, just depending on the type of property. So, and when it comes to the calculating the equity in the property, the surety companies discount the value of the property. You can think of it like if you own a home and have a mortgage, most lenders won't lend 100% of the value of the property because they want to leave themselves some room in case the value of the property declines. And so, a lot of times you have to have 20% equity or at least 10% equity. And so the surety company is doing the same thing where they will essentially discount the value of the property by somewhere between 20% on residential to up to 50% on commercial properties, and that gives them some flexibility in case there is a decline in the market, that they can still make sure to have equity in the property. The last form of collateral is stock portfolios, and really it's stock or bond portfolios and these have to be in non-retirement accounts. Just like real estate, these are accepted by very few surety companies. It can only be non-retirement, so it can't be any IRAs or 401ks. And essentially what the surety company does is they enter into they call it an account control agreement or a pledge agreement, where they will have the right to control that account and liquidate it if necessary. First step in this process is always to get a copy of the brokerage statement so the surety company can evaluate the assets that are held in the account. Generally, they want high quality stock, blue chip stocks or investment grade stocks, S&P 500, that sort of thing, or treasury bonds, municipal bonds, those, even high grade corporate bonds could be acceptable. But they will then, depending on the holdings, they will potentially discount the value of those, just like real estate. There's potential fluctuations. They're going to discount stocks, for example, more than they would discount treasury bonds because there's less likely going to have significant fluctuations with treasury bonds. So they will then determine the amount of essentially equity in the portfolio and potentially be willing to provide a bond up to a certain amount based on the value of that portfolio. Some of the advantages is it avoids the client having to sell the securities and trigger a tax liability, which can be significant. It also, the client may be able to continue trading on the account during the appeal, allowing them to earn their investment returns. And most brokerages will agree to it. In the event that they don't, those accounts can usually be transferred to other brokerages pretty easily. So they're fairly good options in that regard. We also sometimes recommend to clients, if they have their brokerages with firms that are tied to banks like Bank of America and Merrill Lynch, we've had people use their brokerage accounts actually to obtain a letter of credit, because they can usually provide their account as security to get the bank to issue a letter of credit. And sometimes that can actually be easier and sometimes less expensive for the client. So we talked a lot about collateral, and I always like to make sure to touch on bonds, getting bonds without posting collateral. And as I mentioned earlier, it's definitely possible. We do it quite often. The instances are fairly limited to certain types of companies. Publicly traded is one. Not just because they're publicly traded doesn't mean they will automatically qualify, but obviously publicly traded companies in general are larger and have access to capital markets. So there's usually a significant amount of capital that the companies have relative to the size of these appeal bonds. We've done them for large private corporations. One of the biggest differences is just they don't have public information like we can get with the publicly traded companies. So we have to get the CPA audits from the corporations, which is usually readily available and pretty quick. One we don't have up there that we do quite a bit of is insurance companies that are appealing cases. We do quite a bit on those, and they generally they have their information because they're rated by AM Best, and a lot of times they have to file statutory financial statements. We're able to get those pretty readily and make determinations fairly quickly. We have done some bonds for public entities, typically counties or cities, and we've also done them for high net worth individuals. So individuals are possible to get bonds without collateral. They are a little bit more difficult just because they typically don't have outside CPAs that are preparing their financials. Some do, some very high net worth individuals do, but for the most part, they don't. So if we can get enough information, we had one that they needed a bond for $39,000, and this individual had several $1 million of stocks and bonds and cash and real estate that had significant amounts of equity. So it was pretty clear that they were going to be able to satisfy the small $39,000 obligation. And so we were able to get that one done just with their internal information and getting some backup documentation on the accounts that they held. So we'll switch over to talking a little bit about how much these bonds cost. I mentioned earlier that the average rate is probably in the 1% range. They do vary by type of collateral. So cash, providing cash or a letter of credit is going to result in the least expensive premium rate, and that's really driven by the risk that the surety company is undertaking compared to, say, those other forms. Cash or letters of credit, there's not the same market fluctuations that the surety companies have to be concerned about. So, and it also, the other factor is the size of the bond. So smaller bonds are more expensive and larger bonds get less expensive. So for small bonds with cash or letter of credit, it's somewhere between 1 to 2% is kind of the range, and they can get down to 0.2, 0.3% for multi-million-dollar obligations. So they can get fairly inexpensive, and as you can see, even with the low interest rates, the 0.5% that is being paid today, that can cover quite a bit of, if not all of, the premium that's paid, just depending on the size of the bond. And these interest rates are temporary, so obviously over the coming years, we expect the surety company to increase the rate that they are paying back up to that 1 or 2% that they previously were paying. The premiums for real estate or stock portfolios are more expensive, generally between 3 and 4%. There can be some exceptions on the stock portfolios where they, hold those higher grade, like U.S. Treasury bonds. We've gotten rates, of around 1% on those, just because of the low risk and the liquidity. So they can range, but real estate generally is at that 4% mark. So we'll talk a little bit about the process for getting a bond and just how long it takes. One of the main things, if you leave today with anything, is knowing that there are various forms of collateral can be used, that collateral is often used, and certainly knowing the particulars on real estate and letters of credit and stock portfolios, because a lot of people don't know about those. But the other thing I would hope that you leave with is starting the process as quickly as possible. Like I touched on earlier, in California, there is no automatic stay. So not waiting to investigate what it would take to get an appeal bond is critically important. And a lot of people don't want to, spin other people's wheels and waste their time. But for us, from the way we view it is, we would rather have people call us, have a quick conversation. It usually takes 10 or 15 minutes at the most, and we can fairly easily give people a sense for what would be required and how long the process would take. And then they're able to take that information and see if they want to, pursue the process ultimately, and they can better judge based on the timing of their particular case how to approach it. We even encourage people, before a judgment is entered, sometimes even people will know that they're going to get a bad verdict, and so we've had people call before a verdict is even entered. But those allow for great lead time because it extends, the time that we have to that much more, and more time ultimately usually means more options. And so skipping down to the time frame for approval, cash is relatively quick, but not everybody has cash available. So that's why it can be so important to have these discussions. But cash can, we can a lot of times get approval the same day. And I would, in general, say it takes 3 to 5 business days to put a bond in place using cash. Could be, as quick as maybe 24 hours, but in general, it's probably 3 to 5 days. Applicants that qualify for without collateral, 1 to 5 days is probably typical for those companies or individuals where it's that are very financially strong and it's kind of very straightforward. Some that are borderline could take a week or two. So again, having that initial conversation, you can narrow down that time frame, whether it's going to be the 5 days or the week or 2 week time frame. for those that are going to qualify without collateral. Letters of credit can have a pretty big range, and that range is really based on the client's relationship with their bank and the amount of time that it takes them to get the letter of credit. We've had some very large companies and high net worth individuals that, as great of a relationship as they had, they couldn't get a letter of credit any faster than a week. It just, it takes a little bit of time for the banks to go through their internal processes. And I would say that probably on average, it's somewhere around 2 to 3 weeks, realistically. Real estate is the one that can take the longest, and it's because of that appraisal process. So appraisals can take anywhere on residential appraisals. If any of you guys have gotten a mortgage recently, know it probably takes about a week. But for commercial real estate, it can take anywhere from 4 to 6 weeks. Depends on the type of property, how busy the appraisers are, and that sort of thing. So again, we try to allow for that from a timing standpoint. And so 45 days is probably a good basis for using real estate. So something to keep in mind. And our last slide here is what happens to the bond when it's done. So these bonds are non-cancelable. So once they're put in place, they cannot be just simply canceled by a surety company when the client either settles or or the case is concluded. So keeping that in mind, the exonerating these bonds really depends on how the case is concluded. So if there's a decision that affirms the judgment or reverses it in part, those can all kind of take different forms in terms of what's needed. Was there a satisfaction of judgment, and was it a full satisfaction or just a partial? So what just a general rule of thumb is to tell people is when the case is concluded is to contact us. And if there's a settlement agreement, contact us before the settlement agreement is drafted, because generally speaking, we had one recently where they came to us and they were going to settle, and they partially satisfied, but as part of that, they were able to include and get an order to exonerate the bond and discharge the surety. And so that took care of what we needed in order to close the bond out. And that's usually that's kind of the belt and suspenders, approach, and sometimes is required because there's really no other alternative. But getting an order to exonerate the bond and discharge it usually will take care of any situation. There are some times, though, that's not necessarily needed. If it's been reversed entirely or fully satisfied, that may take care of it. But we can determine that with the surety's claims department, specifically on a case-by-case basis. If the appellant was successful in their appeal, and had collateral, part of what we always want to do is make sure that these bonds do get closed out properly, because for two reasons. One, that will determine how fast we can get the surety company to return the client's collateral. But two, we also want to make sure that the bond has no lingering liability, because otherwise, if there is lingering liability, and the surety receives a claim that they are forced to pay out on, then the client will have an indemnity agreement with the surety company, and ultimately the client would be responsible. So the process at the end of closing these bonds out properly is really important for a lot of reasons. So that is the end of the presentation. A couple things to note is I know this presentation, I believe, is going to be made available afterward, but also if you want any articles or additional information, our website is there, courtsurety.com, and basically everything we've talked about in terms of different forms of collateral or just the overall process, we have articles on. So it's a good reference point if you're 2 years from now, you've forgotten everything you've seen here, and need to brush up on it or have a question. Or as always, you can always contact us and we'd be happy to answer any questions for you. So if we have any questions that the audience would like to address, I'm happy to do that now.
Dan, I have a question. I'll just throw one at you. For people who maybe aren't as high net worth, but say they have high net worth family members, friends, relatives, people willing to step in and help them out, what does that process look like in terms of being able to rely on and lean on those people to get a bond secured?
Yeah, great question. So there's really no limitation to who can provide the collateral or indemnify for a bond. So that can come in a variety of forms. In a corporate setting, we've had subsidiaries that have a parent company, indemnify or provide collateral for them. In an individual setting, we've also had, just like you described, parents, business partners, things along those lines, provide collateral. We actually have one right now where the individual owns property with their parents, and so their parents are going to provide their collateral or their interest in the collateral, and they would also be required to indemnify in order to secure this bond. So if it's a good conversation point, if the client doesn't have immediate access, but they do have, someone that can help them, there's no restriction on that.
Is there any other questions from the group? I'm not seeing anything popping in, so maybe we'll give it another minute or so, and unless nobody has questions, Dan, thanks so much for your time, and it's really great informative stuff. And as Dan said, we'll make the presentation available through the STDL portals, and we'll circulate Dan's PowerPoint as well, so that everyone has that and has that contact information for him and the background information provided. So I'm not seeing any other questions popping in. So with that, we'll go ahead and end the webinar, and thank Dan for his time, and hope everyone has a great day.
Yeah, thank you, everybody. Thank you for being here.